All right, weekly market chat. Today we're going to discuss the earnings calendar, show where we're at, what's coming up for next week. We're going to go through a results overview, super big picture. I have actual reports outdated and comments for all these other companies. We're just going to do super high level how the results were, if any changes happened to the fair value estimates. As you can see there, it was a gauntlet of companies, very busy week for us. Then we'll do some latest market rates and commentary associated with those. And then we'll talk a little bit about NAV. I've gotten a lot of questions about net asset value, what it means, why do we care about it, why do we utilize that. And then finally, we'll do a live Q&A at the end. I'm going to be searching for Q&As in three sources. We got the comments underneath the announcement, we got the Rocket chat pulled up, and there's also a chat for the GoToWebinar. Starting off with a review of the earnings calendar. As you can see, very busy week. We had Atlas Co first, that's the ex-C-SPAN. Then we had Ardmore, DHT, Navios Acquisition, Scorpio Tankers, Capital Product, Euronav, Navios Containers, Gaslog, Genco, International Seaways, Eagle Bulk, Diamond S, and then OSG finally this morning. Next week coming up, you'll see we got Scorpio Bulkers on Friday morning. We got Tidewater and Global Ship Lease on Tuesday. We got Navios Partners on Wednesday morning. Then we got Navigator Wednesday afternoon. On Thursday, we got the Navigator earnings call. We got Diana Shipping. We got Torm, and we're expecting Ocanis. There might be a few more that slip in there. I'm expecting Safe Bulkers and Star Bulk to kick up as well. We do not see a press release from them yet, but expecting it this coming week. If you have the analytics access, you can see all this stuff live update in Google Calendar. This is what it'll look like on your screen. So if you have that analytics, you can get into the scenario editor and all that stuff. Just go to Google Calendar. You'll see there's a selection for Value Investor's Edge. Select that and you'll see all the earnings dates and relevant times in there. Of course, that's as fast as I can update it. So if you know there's one coming up and you don't see it in there, please let me know and I'll update that. For run through what we saw this week, Atlas Co was first, that's ex-C-SPAN. I got to reassess that this weekend. They did a weird merger with a power company. Prem Watson kind of jammed it in there, some weird sort of related party stuff. Might have to drop coverage on it. It's just a completely different industry. Don't really understand. The financials are super opaque and there's no real guidance. So the whole thing just smells bad. I don't really like C-SPAN anymore. We'll pay attention to it. I'll give you an update as best I can, but we might be dropping coverage, just an update on that. Ardmore Shipping, they came out first. They pretty good earnings. I say A minus, guidance is pretty good. Fair value estimate $9 reiterated. Nothing really surprising there. The market did not like it for some reason. They had the expectations high, but Ardmore, look, they beat all the analyst expectations. They beat our estimates as well. Very good earnings. DHT Holdings came out solid earnings, solid guidance. We raised our fair value slightly. It's $8.35. That incorporates that 35-cent dividend. It's basically the same ex-dividend, if that makes sense. Navios Acquisition came out kind of a C on their earnings. There's a lot of opaqueness to it. It's really just about a paragraph of financials. We really need to see the SEC filings to get the advanced details on that. I'm going to wrap up Navios Europe too. It's kind of messy. So $7 is still there for now, but I need to review it. Scorpio Tankers, good earnings, decent guidance, $34 reiterated. Capital Product Partners, pretty good earnings, but their guidance was really weak. They didn't want to talk about anything with coronavirus, basically pulled all their guidance, wouldn't talk about the upcoming container ship charters. Not really good, comfortable feeling on that one. Their NAV is like $22 with charters. It's about $10 without. We lowered our estimate to 14 off 16. Euronav, solid earnings, solid guidance. Fair value raised slightly. We raised it to $14.60, including the dividend. That dividend's $1.10, so it'll be $13.50 afterwards. So it'll be funny on that, but that's a big dividend, so it does actually change our fair value estimates depending on whether or not you bought before or bought after, because it's $1.10, big dividend. Genco Shipping, solid earnings, solid guidance. And keep in mind these ratings, right, on earnings and guidance are based on what we expected and based on what the market's doing. So like, look, Genco earnings weren't very strong, but they were a B compared to like what we expected, right? So $10 fair value estimate reiterated for Genco. Continuing, yeah, it was a big week this week. Gaslog, B plus on the earnings, B plus guidance. They're making progress on the refinancing. $5 fair value estimate looks about right. Gaslog Partners, B plus on the earnings. They were fine, doing pretty good there, but the guidance is C for sure. The steam ships are coming off charter. They didn't announce anything particular with those, and the steam rates are terrible right now. $4 fair value estimate reiterated. We already knew the steam vessels were pretty bad, but it's not going to be real pretty there. I think the preferreds are fine, but I would stay away from the common. Navios Containers, earnings were decent, B minus guidance. They did a couple rolls on decent rates. They had a couple rolls that just say spot, so we're not sure if they're going to be able to utilize that or not. $2.50 reiterated, but we need to review the actual SEC filings. Navios is pretty funny. When they put out their press release, they only put like one or two line kind of items like cash equivalents, long-term debt. They don't list all the other stuff that's going on. You have to go into the SEC filings for that. That's normal. I just don't want to jump the gun too fast. International Seaways, look, the earnings were pretty good for this quarter, but the guidance was pretty weak. Not weak enough to be a C, but definitely weaker than, let's say, DHT Holdings or Euronav. $35 reiterated. That's basically actually below their forward NAV. It's a little bit between their current NAV and Q2 forward NAV. Eagle Bulk earnings were very good, A-. They beat the TCE estimates, and their guidance was also higher than the market. They got an internal logistics business in bulk that's doing good work. $3 fair value reiterated. Diamond S, earnings themselves were really good. They beat our expectations, but the guidance was pretty weak. They had some issues with getting trapped on demurrage. We lowered their fair value from 21 to 20. Keep in mind, NAV is actually about 25 looking into Q2, so that's actually a pretty big discount on NAV. They're not pressing forward with repurchases at this time. They're focusing on deleveraging, which is going to slow down that gap, right? Because they're not repurchasing. Overseas shipholding, very strong earnings, solid A. Guidance also B. The second half of the year, they were kind of tepid on just because they didn't really know with COVID. But the first half, EBITDA is looking really good. They're making 60% of their 2020 guidance in the first half. So it's pretty low hanging fruit to hit that 120 million in the back half there. Fair value estimate, we're actually raising that from $4 to $5. I'm going to post up a report tomorrow with more details. But if we look at comps, C-Core Holdings would be a big one. Kinder Morgan's Tanker Outfit would be another one. Saltchuk Resources is a private private enterprise that's been acquiring a position. If we look at the comps of basically like 7 to 9, 7 to 10 times EBITDA, we're talking 6 to 9, maybe even 6 to 10 per share for OSG. So stock is super cheap and it's kind of misunderstood. A little bit of a sell-off today. I think some folks in the message boards thought it was a tanker company. Look, it is. It's a Jones Act tanker company, but they're not really doing any floating storage. They're doing logistics down the rivers, up to the refineries, around the ports, and so on. They're not doing, the VLCC type work. That covers earnings from a super high level view. I encourage you to read our actual reports to get more details than that. Latest tanker market rates. This is this week's and last week's. Note, this is posted on Thursday night, so it's not today's rates. It's one day delayed. I use this one because it's the public one that people can see. Nordic American Tankers shares it. We had some issues with broker rates. They're picking some of the more optimistic ones. So as you can see here, we have this week's and last week's thrown up on the screen. VLCCs are down from about 101 to 55. That was last Thursday. Last Friday was already down to about 70, so the decline's not as big as it looks there. Suezmax off from 70 to 45, pretty big decline. Aframax also 58 to 37. So we're seeing a pretty steady decline in crude tanker rates. LR2s are still super strong. Don't want to miss that point, but they did decline from about 175, 180 down to about 130. LR1s are off from a little over 100 down to 99. So still really holding solid on that 6-digit range, which is basically what Scorpio said on Wednesday. They said, we're doing 6 figures still on LR1s. MRs are kind of a funny market. So we have the US Gulf market, which is kind of weak. It's in the low to mid 20s, and Diamond S confirmed that today. We got the Asian market that's strong, and that's where that 40 is coming from. That's coming from the Asian side of things. So about 30 is more so of a realistic average. That's an example. I've had a lot of people ask me, hey, look, the brokers are putting out ridiculously optimistic quotes. What are you doing to adjust? So from now on, what I'm doing is I'm utilizing 3 to 4 different broker reports, looking at all the routes. If I see something that flags as out of line, I'm going to adjust that down manually. So there's one example of what I did there. MRs, we're going to plug in 30 into our models, not 40. 40 is way too optimistic. So the big winners this week, the big losers were VLCC heavy companies. VLCC rates came down pretty heavy over the last 2 weeks. DHT Euronav are kind of in that bucket of like where their rates are getting hurt. Relative winners are those with LR product tankers. So Scorpio Tankers is number 1, Hafnia would be number 2, and then Torum would be number 3. So it's kind of the big relative winners. Doesn't necessarily mean they're the best value today, but those are, if we're just looking at rates, that's what's going on. Looking at container ship rates, look, this is a big pivotal point here. We can see the line coming across the middle of the screen. That's the 5-year average of the HARPEX. Those are container ship rates. So we're just about to crack through the 5-year average. And if you look at the graph over here on the right, it's just a steady plunge down. So we started cracking in basically January, and when COVID kicked in, it's been a steady plunge. I expect that to keep going down. In fact, we might hit fresh 5-year lows here within a couple months. Container ships is a very nasty area. There's some good values out there, but it's an area where I'm very leery to step into it. Next up, dry bulk. So dry bulk's it's kind of been a favorite deep value play. I know some folks that have been selling tankers and buying bulkers. Look, dry bulk is a total play on China. So it's going to depend on the Chinese recovery and how that works out. As we can see, the rates did their seasonal thing. This is a 1-year chart. The rates did their seasonal thing. They came down and dipped around in January, February. That's the Lunar New Year. Happens every time. We totally expected this part of the decline. Problem is, normally we expect a big increase coming afterwards, especially into the summer. That just has not happened with coronavirus. I'm pretty skeptical about it happening with China unless they really put a lot of stimulus in. Something to watch, but these rates are not good. You can see year over year, and 2019 was a pretty bad first half for bulk. Second half was good, but first half was weak. And you can see that even with that first half, we're comping way below. We were about 1,000, 1,100 last year. Now we're at 514. So dry bulk also not looking good. So that covers the market rates. We're going to talk about NAV and why that matters and why we focus on it. So NAV stands for net asset value. That's strictly the market valuation of the assets, those ships, minus their net debt. And why do we care about NAV instead of another metric? Look, shipping is a commodity market. And especially in tankers and bulkers, there's what's called an S&P market, a sales and purchase market. There's several dozen tankers and bulkers that are traded pretty much every month. So the market kind of corrects itself. So when owners and industry participants are bullish, right, the prices of those assets will go up. When they're bearish or in distress, the prices will come down. Sort of like consider it like retail office space. Look, you have comps throughout the market that you look at. Similar to that, very commodity market. You can use NAV in all the sectors, but we just mainly use it in tankers and bulkers. We have it for containers, we reference it, we have it for LNG, but tankers and bulkers are the really liquid segments that we can look at. Secondary markets already doing this on their own. They're looking at the net present value of expected cash flows. So when you buy a VLCC, a modern one, for like $90 million, or recently we had them over 100 million, that is that person going on the market and saying, I can buy this VLCC and make more than 100 million net present value over the life of this asset. So all that calculation is already being done by those buyers and sellers in a separate market. Now, if you slap them all together, you take all the ships, put them together, put them in a bucket, put them in a company, now you have this bucket of assets minus the debt. So that's your net asset value. So it doesn't need to be overthought too much. That's basically what a company is intrinsically worth. Plus or minus a management premium or discount. Look, if the management is terrible, they're going to rip you off. There's related party discounts. They're just incompetent. Then yeah, a discount to NAV probably makes sense. Look, if the management's really good and they're doing things that you couldn't do on your own, right? They're getting access to special contracts, special deals, very niche assets. Like none of us could really go out and buy a VLGC, right? A very large gas carrier. We wouldn't know how to operate it, wouldn't know what to do with it. So that's kind of a special business that maybe deserves a little bit more of a premium, of just one example. So that's what a company is worth. So unless there's some sort of like fraudulent activity or something, you should not see sub net asset value valuations for a long time, right? Because that is a broken market. It clearly shows that the stock equity value is less than the combined asset value. So either the assets are bloated, right? But people are out there buying them, selling them, so clearly they're not bloated, or the equity is undervalued. So just an example of the breakdown there. Finally, a premium NAV valuation, that's not really sustainable either unless it's like a reasonable one. Say I say 20%, maybe 30%, maybe you could argue for something like 40%, but that's only if it's a super special structure and a really, really good management team. So basically NAV should trade in a band, right? It shouldn't really go below like 80 or 90. It probably shouldn't really go above like 120. So anything below 100% is mispriced unless the management team is incompetent or fraudulent or something like that. You could say the assets are mispriced, but they already have their own market. So it's sort of second guessing the industry there. So look, we look at all metrics. It's not just NAV. For valuations, we look at price to earnings, price to operating cash, price to free cash, enterprise value to EBITDA, and dividend yield as well. So we look at all those, not just NAV. And a balance sheet, we're looking at the debt to assets, we're looking at the company liquidity, we're looking at the maturity structure of the debt. We're also looking at any covenants that might come into play. And then finally, management. Look, we're looking at the competence of these guys. So do they know what they're doing? Like, look, I mean, I look at Bug B and I look at Craig Stevenson as two guys that ran OMI back in the 90s and just made a gangbusters return and into the 2000s, and then they sold it to TK and Torm at the top. So I look at Bug B and Stevenson as some of the smartest guys, and maybe other guys not so much. I know a lot of folks have great respect for Hugo de Stoop over at Euronav. Yes, definitely a guy who has earned his chops, very financially competent, understands the market, big picture, very conservative. So yeah, definitely the competence matters, the alignment matters. Do they have share options? Do they have warrants? What kind of alignment? And then finally, the corporate governance. We don't want to mess with those related party structures and so on. Over time, I've been in the industry now for, it's coming up on 12 years. Value Investor's Edge or 5. Price to NAV is the best long-term intrinsic value indicator, right? I mean, people can argue, you can hear bears argue that, the assets are way undervalued and NAV is misleading, but no, it eventually corrects. And you can hear bulls argue that you need something higher than NAV, that NAV is a steal value. And I think I explained this before, but look, that's like saying the value of my house isn't the value, that's just somehow like the plywood of my walls. No, right? The value of my house on Zillow is the value of my house. Same for a ship on Vessel's Value. That's the value of it. It's not just steel, it's the earnings capacity of that asset. So NAV can go up and down over time. So the question we have to ask ourselves is, where are these ships versus the mid-cycle? Right? It's not just buying below NAV and selling above NAV. We also have to understand where those assets are in the cycle. So look, most of the money in shipping is made from asset play. It's not actually made from buying a new build, holding it for 20 years, and then demolishing it and buying another new build. That's not a very good way to make money in shipping. You'll get like 6-7% returns, maybe. right? That's not really how money's made in shipping. So the way the money is made in shipping is buying ships cheap, right, when nobody wants them, running cash flows up when the markets are really good. And look, the markets are only good 2, maybe 3 years out of 10. It's a tough industry. So you got to get those cash flows in strong markets, and you got to sell the assets when people want the assets. So if people are buying, it's time to sell. So it's a very, very counter-cyclical industry. All the profitable ship owners like Frederickson and those guys, they made most of their money in asset play, and then they made a little bit of their money in those strong 2 or 3 out of 10 years. And look, the same exact thing is true for the shipping stocks. You have to buy the shares cheap. That means below NAV, and you want to see those assets below or equal to mid-cycle. If you're below NAV, but you're way above mid-cycle on the assets, then it's no good. Secondly, you want to get those strong cash flows. During those cash flows, you got to make sure you don't have a management team that's going to screw you. You need the management team to give you big dividends and accrete that NAV, right? And then finally, you got to sell the shares when everybody loves them. So when they're above NAV, when the assets are above mid-cycle, everybody's dancing around and loving them, it's time to sell. So it's hard to do that because that's when everybody loves them. Like everybody loved tankers a couple weeks ago. Okay, it's getting a little warmer, and now everyone hates tankers. So it's a very, very fast cycle. So what do? How do we figure out our NAV? We use the best sources. First, we have Vessels Value. They have live valuations. They're updated daily. They use proprietary algorithms. They have dozens of inputs. It's all correlated to the sales and purchase data. Anytime something comes across the radar that did not fit their algorithm, they're constantly, it's like almost like machine learning. They're constantly improving it. Almost every single transaction I've seen is plus or minus 5% of Vessels Value. Very, very rare for that not to line up. Secondly, we use something called Clarkson's Shipping Intelligence Network. That goes with broker values. They're updated weekly. So not daily, but weekly is pretty good. And those are all based on the recent sales and purchase activity and near-term projections. Those are the two best sources on the market. I challenge anyone to find a better source. There are broker reports that come out like Alvarez, Weber, so on. We do look at all those as well. Hal Robertson's another one. But look, if someone's out there pumping around their own NAV targets, I'm not going to name names, but there's a certain analyst out there that's literally making up their own 5, 10, 15-year values. If they don't align with Vessels Value or Clarkson's or a reputable broker, be skeptical of that, right? Utilize the stuff that's actually out there that's actually based on real transactions. So we'll walk through an example really fast. This is Vessels Value. This is DHT Holdings as of today, so Friday, 8 May. You can see, look, they have 27 ships. It's worth 1.62 billion. Demolition value is about 370 million. You can see this stacked up. Average age is 8. So I have a dashboard like this for every company we own. Jumping down, you can see their fleet history. Now, this doesn't mean the black dots are adding ships. So you see they grew a lot, 14, 16, 17, and then you can kind of see the value over time. You can see the valuations roughly steady, but they improved a little bit into mid-19, kind of October 19. They came down into February and then ticked up just ever so slightly. They're well below where they were in like October, November of last year. Dropping down a little bit more, you can see a fleet list. We have this. It shows all the ships, what they're worth today, how large they are, what their age is, where they're built. So today we're going to walk at 3 comps. We're going to look at DHT Bronco, which is kind of a brand new ship, more or less. It's 2 years old. We're going to look at DHT Amazon, which is kind of a middle-aged ship, 9 years old. And we're going to look at DHT Condor, which is sort of a more vintage ship. It's about 15 and a half years old. We're going to use all Korean builds to make sure that we're not just getting confused on China versus Korea. So first one, look, DHT Bronco, basically brand new, 2 years old. Over the last 2 years, the values went up 6%. So it's basically stable, hasn't moved a lot. It strengthened a little bit into October, November, and it came down slightly into the new year, up 6% over 2 years. Now, the ship was getting a little older, so there's more than 6%. By the time you offset depreciation, it's about a 15% change, so a little bit of an improvement. Now let's look at DHT Amazon, middle-aged ship, 9 years old, 7% change over the last 2 years. So not a lot of change. It's been a very steady asset. It's off a little bit from the fall, but not too much. When you include depreciation, we're at 15, 16% of appreciation. Now, hold on to your seats on this one. DHT Condor is an old ship, 15 years old. So this one moved up big time, moved up 50% in the last 2 years. And that's because, look, you go back to 2018, this was a really bad, crappy market. And the expectation was that Condor would be scrapped probably 17, 18 years. Now the expectation is that Condor can do about 20. So you're adding more expectation of life. Remember I said the value of an asset is the net present value of those future cash flows. So all that work is already being done by the market. That's what NAV is. So there's already buyers and sellers, smart people on both sides. So look, this is a question you should probably ask yourselves. Where are the assets in the cycle? What's expensive? Okay, VLGCs, propane, those are well above mid-cycle. Those are pretty expensive. Makes sense. Expensive assets are going to be in good markets. That's a very good market. It's been ripping for a year. They're expensive. So when you see a discount to NAV for VLGC like Dorian or Avance, just keep that in mind. 15 plus tankers. Those are 25% above the mid-cycle. Look, we can just see it right here with DHT Condor. That's an example. That's a little bit more expensive of an asset. Moderately priced assets. These are basically mid-cycle, more or less. Product tankers, slightly above mid-cycle. Modern crude tankers, like the first two DHT ships I showed you, basically right at mid-cycle. LNG, slightly below mid-cycle. And in containers, ULCCs, the large containers, are slightly below mid-cycle. Those are like those big ocean liners with like 18,000 containers and so on. What are the bargain bins? Look, the bargain bins are dry bulk. It is moderately below the mid-cycle. And then finally, those smaller mid-sized containers, like the stuff Global Ship Lease owns and so on, and Navios containers, those are considerably below mid-cycle. Most of them trade right around demolition value, cheap as they've ever been. So that's a very interesting way to look. If you're going to go in these bargain bin assets, you got to be careful though, because they're bargain bin for a reason. So conclusion in shipping, look, how do you make money in shipping? First thing, you got to find an aligned and competent management team. You can't be partnering with someone that's not going to be with you. You got to find a balance sheet that doesn't have any near-term risks. You got to buy stocks at large NAV discounts, and ideally also the cycle discounts, right? There's almost like a double discount when you do that. So that's like, you think like Q4 18, Q1 19, and think 2019 was the most profitable year we've ever had. And look, we were getting large NAV discounts and cycle discounts. Now we're getting a little bit more of a mixture. Finally, the cycle must be reasonably near term, right? You can't wait 5 years for the cycle. It's got to be a year or two away. Look, we know the supply. That's not hard. We have all the analytics on supply. We know exactly what's coming down the market. We know exactly what's getting scrapped. Demand is always a wild card. So look at crude tankers, right? We were bullish on crude tankers because we knew the supply was absolutely beautiful. Oldest fleet on record, tiny order book. All it took was one little spark on the demand side. So we knew either IMO 2020 or growing US exports, we knew something would make it go crazy. And look, Costco sanctions made it go crazy. IMO 2020 buildup went crazy. Obviously COVID, floating storage made it go crazy. So tight supply, and all you need these little sparks. Doesn't even matter what they're going to be. There's always going to be a wild card. Also, there can be wild cards on the downside. Look, dry bulk was looking pretty good into early 19, and then we got the Valley Dam collapse. Dry bulk was looking good into early 20, and then we got COVID. So you got to watch that supply. Demand is always going to be wild card. As the cycle improves, watch, we want dividends, or we can sell the calls when things rip. That's how we generate additional income against our stocks. Finally, keep your eye on the price to NAV and overall cycle values. When that price to NAV goes up well above 1, look, Nordic American Tankers a couple weeks ago, it's going to be tempting to want to ride it. And you can use trailing stop or something like that, but that is the time at which we want to exit, especially if the overall cycle's high. If your overall cycle's high and your price to NAV's high, it's time to exit. And then when people love the sector, right, time to hit the exit. So Nordic American Tankers, clear example, exit, maybe even short it. And look, yes, I know, obvious, right? Captain Obvious. This is easier said than done. You have to have the research and analytics. You have to look at the macro markets. That's why we have James Catlin working for us. That's why we got Michael Boyd doing the oil stuff. That's why we got a whole new analytics platform we developed with Roscoe. We got a new analyst we're hiring in about a month or two. So yeah, that's why we're doing all this. It's easier said than done. We got to have the research and analytics to help us out. So I realize that went a little long. A little bit heavy on the data. We'll post up the video and we'll get to it later. So now I'm going to jump into the question and answer session. I'm going to pull up the webcam as well here so you guys can see what I'm thinking. If you ask me a crazy question, my eyes will bulge out or something. Here we go. So webcam coming on. All right, so starting with the questions, I'll go on the order they received. They're over here on the left screen. So first question from non-zero sum. He's asking about Navios acquisition 2021 bonds. When you're talking about bond repurchases, didn't hear anything, but it sounds like an obvious thing to do. Are they doing it? Why not? We heard anything about this in earlier calls. So yeah, Navios Acquisition has been repurchasing their bonds steadily in the open market, around 60 to 70% discount. In the recent Q1 call, remember I said I got to go into the SEC filings and review them. Very light on details. They're trying to get that Navios Europe 2 thing to roll forward. They did not disclose any additional bond repurchases. I was kind of disappointed, kind of surprised by that. Look, those bonds are really risky. I mean, they're secured bonds, but the leverage behind them or the assets behind them is only about 55%. But the bonds are trading at 50 or 60%. So it's definitely some interplay there. If the company goes bankrupt, you're going to have to fight for those. You're going to get the assets off the top. So that's 45, 50% recovery. You're going to have to fight for the scraps. So in that one, someone asked me the odds. It's hard for me to say exact odds, but it's probably 20% odds or something like that they go bankrupt. Probably like a 50% chance there's some sort of tender or a roll where they try to push it out to like 24, 25, and then probably like a 20 or 30% chance they just pay it off straight. That's obviously the best outcome. It cashes out at 100. Those bonds are pretty risky, so I do a lot of due diligence before thinking about something like that. Another question about Ardmore. Next question up. He's asking, what's better, purchase stock at 60% of NAV, or buy cheap assets? And that's sort of the question I framed it to Tony and Paul Tivnan, because they were being kind of, a little catty about not wanting to do share repurchases, and their excuse was that they couldn't get enough shares. Yeah, maybe you can't get as much as you want, but why would you not try? So in that argument, look, you can either go out and buy ships for $1, or maybe you're like the best deal maker in the world and you can get like a 10% discount on your ships. So you're getting ships at 90%. Are you going to buy ships at 90, or are you going to buy your stock at 60 cents on the dollar? So it really comes into question with capital allocation. I think what they really want to do is delever first, and they don't really want to spend money on excess dividends or repurchases. So I think they should have probably just answered like that. They're getting a little bit dodgy. So yeah, anytime you're under NAV, it's pretty stupid actually to go out and buy ships. So hopefully we don't see that from any of these companies. Jan saying, you say Eagle is a top pick. Why was it not added to the Value Investors Edge portfolio? That's a good question. So we have a model portfolio that we started off with in 2020, and we update that. I try to roll it just once a quarter. I don't want to be making updates every week, every 2 weeks, just on one pick. Look, everything's cheap, so I don't want to get too crazy at this moment. If there ever is a time where like one huge sector rallies and the other sector doesn't move, and it's like, rotate a little bit, maybe, right? But I want that thing to be fairly easy to follow and track, and not the performance. Everyone kind of understands what that is. So that's why I don't update it like on every little week. As far as what the top picks at the exact moment are, look, you can jump into the live analytics platform. I'm going to try to bring it up on the screen here for folks. Bringing it up here, live analytics platform. We'll see if it'll load for us. Going to run over here to shipping universe, shipping coverage universe. So when this loads up, this is every single company that we follow, and it's got every single fair value target, potential upside here in the middle, and then it's got a link to the latest report that we've done on them. So if you want to see what the top picks are, you just go up here to potential upside, and you go sort Z to A, and it's going to put the top ones up top. If you want to pick out, get rid of the crappy firms here, you can clear this and let's just pick things that have A's and B's. So we're going to just do only A and B on risk management, and then we're going to do only A and B on the actual management team themselves. I misclick. It looks like I misclicked. Sorry, guys. All right, here we go. So there's a filter. I'm only picking A's and B's on risk, and I'm only picking A's and B's on management, and I'm sorting in order of potential upside. So this is actually what I believe are the best buys on the market. So look, Avance, number 1, Herg LNG, number 1, number 2, Golar, number 3, Flex, number 4, BW, number. So you can see the order of things that I believe are good values. So let's see where the first crude tanker is on here. Crude tanker, Diamond S is the first one on this list, and it is through like number 14. So yeah, what does that say? Yeah, dude, crude tankers are not the cheapest stocks on the market. They're the most popular, but they're not the cheapest. So where did Eagle Book land? Look, Eagle Book is right down here, right next to Diamond S, which is my favorite tanker company by far. If you want to sort by industry, you go here, broad industry, and you can pull this off and just go down to clear all, just pick dry bulk. You can see the firms right here. So dry bulk. So cheapest one is Star Bulk. We're long that one. Genco's next. We're not long. And Eagle Bulk here is a third. Look, Eagle Bulk rallied hard today. So I bought it at 150. So it was number 2 on the list when I bought it. Already had a long position in Star Bulk, so I picked up one in Eagle Bulk. Just kind of the walk through there. You can kind of see what's going on and what's cheap. Keep in mind, fair value estimate is based on my projection of current and forward NAVs. So we're really doing what I told you guys in that slide, number 1 to 8, when to buy, when to sell. So this is a time right now. If you go back here and select all industries, look, this is a time to be buying LPG, a little bit of LNG, maybe some dry bulk. You don't really buy a lot of tankers until you get down here, maybe Diamond S, Okeanis, International Seaways, like Nordic American Tankers. Well, first, they're not even on here because their management sucks, but you can see the list of stuff, right? So anyways, hopefully that helps. Back to the presentation here. All right. I'm looking at Euronav fleet. Oh, this is a really good question from Pangolin Valuations. He's looking at Euronav fleet, and he wants to know how much stress does it take for them to go to 1 times NAV, because they're super discounted right now. He's asking how much a 6-year-old vessel costs. He's asking about 60 million for VLs, and he's asking about Suezmaxes. So I went to Value Investors Edge and I looked that up, and the VLCCs are about 60 million, like he said, and the Suezmaxes are about 40 million. So then what I did, to go to the next slide here, is I got into our live analytics model. I just did this like 5 minutes scrambling before we started the webinar. I loaded this up and I made up a scenario that makes Euronav equal to about 1 times NAV. So this is what has to happen in the market over the next year for your NAV to be correctly valued. You got to have VLCCs at 60,000. You got to have Suezmaxes at 30. So huge come down in rates for the entire next year. And this number 2 part here in red, you got to have a 40% vessel valuation drop, significant plunge, 40% plunge in assets to get down here. And even then, look, even then Euronav's worth over $10 a share. So it's a very cheap stock. One of the reasons Euronav can take this kind of pain and this kind of gut punch, because 40% is a big gut punch, that's because their leverage is so low, right? If I went to a highly levered company like Navios and gave them this kind of gut punch, they'd be bankrupt. So keep that in mind when you're picking companies. Just to nerd out, the exact numbers would be 60 million down to 40 for a 6-year-old VLCC, which is like all-time lows, and 40 million down to 24 million for Suezmaxes, which again for a 6-year Suezmax is like completely unprecedented. So you basically all-time record lows almost for assets for Euronav to be worth 1x. So the market's pricing in a pretty terrible market with no recovery. So it's a pretty significant stuff there. All right, RD Junkie's asking, comment about coming oversupply or not, number of LPG ships. If one thinks product storage is a thing, then is Scorpio the way to play it, or is Diamond S or Torum or something else better? So LPG ships, yeah. So the issue with LPG ships is that U.S. exports are at risk because look, there's a lot of oil getting shut in. If oil gets shut in, LPG byproducts are going to come off. And if U.S. LPG consumption stays steady, which it has been over the last decade or so, if that stays steady, they're not going to have as much surplus to export. The VLGC market is on fire mainly because of the arbitrage between the U.S. Gulf and Asia. So if that arbitrage goes away and we just fall back on kind of the traditional market, which is MEG, Middle East Gulf to Asia, then the LPG market could weaken significantly. Remember when I said those assets are trading above cycle values? So yeah, they're above cycle values because it's a hell of a good market, something to watch out for. I have stress tested the heck out of Avance, out of Dorian. You would have to have asset prices collapse by 60%. I think in that range, maybe 55% to justify the current valuations. So it's basically impossible to take Dorian down below like 7 or 8. Avance a little bit riskier, a little bit more debt on the balance sheet. There is a way you can torque the scenario hard enough that they could have some financial difficulties in like 21 or 22, but very cheap stocks, but also some concerns. So I don't fault anyone for being more concerned about that. JD Ferg, he asked, given the bias in broker rates, as explained in the article, what is your process for incorporating broker numbers in your forecasts and models? Do you apply a set haircut, for example, to Clarkson's? In your experience, is this mainly an issue only in strong markets? Yeah, very good question. So yes, normally in a normal market, I do a trailing 5 to 6 weeks from when the rate comes out before I model it in. We fine-tuned our models over the last 5 years on Value Investor's Edge. Normally, we're hitting them within 5%. This was one of the first times. We had it happen about a year or two ago on the lower end as well, but this is one of the first times we've really had this kind of big miss. Yeah, it's because when there's a really strong market, you'll have maybe like 120 on VLCCs one day. You'll have like 150 the next day. You'll have like 200. You'll have like 250, and it'll come back off. So, 120, 150, something like that. Well, the problem is on the 120s, on the 150s, you're fixing 5, 10 ships. On the 200s, you're fixing 2 or 3 ships. On the 250, you're only fixing like one vessel, right? And it backs all the way down to like 120, 140, and you fix another 10 ships down there. So you blend out the average, you do a volume weighted average, and that comes out maybe to like 160. If you do a straight average, it comes out to like 190. See how that 30,000 came in out of there? So it gets pretty crazy. Unfortunately, the data is not volume weighted. So it requires a little bit of guesswork on that. What I've been doing is I've been trailing back and applying a 20% discount. Unfortunately, with VLCCs, it was both a trailing back and about a 30%, 35% discount. It's the largest discount I've ever seen, but this is also some of the largest volatility I've ever seen. So what we can do in these markets, first of all, we can do what I showed you on like slide 2, where I actually just straight up disregarded. I'm like, yo, Clarkson's, this estimate is bullshit. Like it's not 40, it's like 28 or 30, and I can estimate it myself. Right, I can take all the weighted average brokers and do some legwork myself. That's usually I don't have to do that. I'm starting to do that now. I can also apply a 20 or 30% trailing haircut and sort of like, fine tune those models so they're a little bit better. So good question. Yeah, it's pretty unprecedented. Normally the rates that brokers have are what you're going to see, maybe 5-10% off, but nothing like we're seeing now. And it's just because of the epic volatility. We'll refresh this article here, see if any other questions popped up. Looks like we have one more on the article, and then I'll jump into the chat. So from Pete, any additional thoughts on the wind down of Navios Europe 2 at Navios? Any chance that Angeliki sells his ships on the market as opposed to pushing them down to Navios partners? Do you think there's any credibility to your statement that limited sales of ships are happening due to the COVID? And how do you think that will play into the COVID wind down and where ships go? Yeah, I think it is reasonable that not a lot of ships are being bought and sold outside of tankers, right? Like tankers are still getting bought and sold because they're doing, the good work. But bulkers, yeah, a little bit. But containers, LNG, no, nobody's selling those. And I told you at the start that tankers and bulkers are kind of the liquid markets to begin with. Nobody's buying and selling anything in containers because nobody knows what the hell is going to happen. And I showed you a chart that shows that we're cracking through the 5-year averages. So it's not a very liquid market. So no, she's not BSing us on that. But as far as what she does, Navios acquisition seemed to suggest that they were going to take the assets directly themselves, that Partners was not going to be involved, and that they were going to hold those for sale. That's what they suggested on the call. Now, we've been suspicious for years that those assets are all going to go to Navios Partners. I think that's part of the big discount the market has on those. Kind of a hairy mess. We're going to keep following it. We're going to look at the SEC filings, and we're going to adjust accordingly. So that's probably all about I can say for that for now. I'm going to jump into the chat now. Got that pulled up. Appreciate you guys sticking with me. I got a hard stop at 2:30, so we got about 10 minutes here. Any hope of a near-term factor that could help DHT and Euronav call option prices expiring mid-May? Oh man, other than obvious possibilities like oil price diving to single digits, and yeah. So look, man, I own the Scorpio bulk tankers 25s. Look, man, if oil tanks crashes on Monday, if something ridiculous happens, if Scorpio Tankers comes out with their charter book and it's really good, if Robert Bugbee comes out and makes an enormous call purchase, look, I mean, shooting the moon, right? We got a week left. Pretty much, those are pretty much losers at this point, just being frank. Look, I said 20, 30 times in the chat, smart money is selling calls and selling puts. That doesn't mean I don't like to gamble a little bit. Look, I live in Las Vegas. Look, I like to go out. I go to the craps table once in a while, but call options out of the money, short dated, they're gambling, right? And you're hoping for some sort of short squeeze. You're hoping for some sort of market reallocation. So yeah, if you're buying May short dated call options, look, it was a gamble. We had some fun. But it's like coming to Vegas. You have some fun at the craps table. It doesn't always work out well. Now, Junes and Julys, yeah, I think there's some legs in those. I think there might be a bit of an upturn on those. But May, yeah, dude, I own the 25s myself. And yeah, I don't expect to see anything from those. I expect we probably threw some money away on those. Let's jump into the rest of the thread here. Sorry, folks, I know Rocket Chat is not always the best. Oh, I posted 2 things in the Q&A that I want folks to just be aware of. Marine Money did an excellent webinar with Randy Givens of Jefferies. It's just it's 30 minutes long. It's on YouTube. He does basically about 15 or 20 minutes. It's kind of scary. He basically more or less what I just did for you guys, and then he takes a Q&A. It's kind of scary because we're almost like kindred spirits right now, me and Randy. Which Randy's a great guy, very smart. He's done a good job in the industry, but I'm more of like a natural contrarian. So I actually feel more comfortable when like Joachim goes bearish or when John Chappelle comes off. I actually feel better about my position. I don't really like it when me and another guy are just like totally agreeing. But look, Randy does a good job, and I think that webinar is worth watching. Even if you're bearish, right, on the sector, just check it out, see what he says, see the evaluations he throws out. The second thing is called Talking the Tanker Trade. It's a podcast that I actually recorded it Sunday. So it's a little bit dated. 5 days is it makes a big difference in this market, right? But no, I think it aged pretty well, and it's just talking about the overall market, the overall shipping market, overall tanker market. It talks about earnings coming up, how expectations are maybe a little bit too high. So I think it's just a good generalist discussion of the market. So I would encourage folks to check that out. Feedback, right? If you don't like it, just let me know, right? We'll make things better. G&D value, do you include net working capital in your NAV calculation? Like current assets, yes. Like accounts receivable, absolutely. But I also include it on the liability side. So yeah, I guess the answer is yes, but it's not just one-sided. When I say total liabilities, I don't just take bank debt. Look, I take operating leases, capital leases, bank lease, accounts payable, anything that's in there is basically included. So it's a very conservative number on the net debt. However, I also include cash equivalents, accounts receivable. So yeah, working capital. That's the proper way to do it. Look, I mean, I've had pushback. People say, no, you can't include working capital, but that's like saying I can't include all my ships in my NAV. So no, we definitely include that. What level of stock ownership do management teams of International Seaways and Diamond S have any relationship to not being more aggressive with buybacks? I can't tell you exactly off the top of my head. I think it's like 3% at Diamond S. I think Craig's got around 3%. I don't know off the top how much Lois and Jeff have. I know it's a couple percent. Look, they get stock options every year, and their incentive packages are aligned with getting the stock price up. They're not trying to like talk the stock down or anything like that. Do they own as much as we'd like? No, but these aren't very rich people, right? I mean, Lois and Jeff and stuff, and Kevin Kilcullen at Diamond S. I don't know about Craig Stevenson. I don't know his personal business, his personal finances. These are not super wealthy people. So there's probably 100 members, 200 members on our chat that have more assets than these guys do. So do they own like 20, 30, 50 million in the stock? No, they don't. But also beware of some of the companies like Zakos, where they own, half the company, but they're also screwing you with related party stuff. So it's not quickly accessible, right? What I look at when I say alignment, I look at what the warrants are doing, what the options prices are doing, and how their competence is. So I have no questions about Jeff and Lois's competence, but I know there was some pushback. I know there's some pushback during the call about their presentation, right? It's from home, it's COVID and all that, but maybe like their slides were a little bit amateurish and so on. So yeah, we'll filter that feedback to them in a polite, professional way. But no, as far as their competence, no, they're doing a good job. I feel like they're fully aligned. With TNK's recent long-term fixtures, do you have a guess to what their debt to assets will be in a year? Yeah, that's a good moment to highlight TK Tankers. This is a company that went from 80% debt to assets last fall. I mean, we had Fotis. Fotis is a good analyst, very bearish, but Fotis back at Morgan Stanley, he said TNK was going to dilute itself at like 50 cents a share. That's $4 reverse split adjusted, or $4, a share back in like late 19, because they were going to like run out of money. Like they're 80% debt to assets. Right now, they're already down into like the mid 50s. I project by the end of this year, including their fixed charters, they're going to be under 30% debt to assets entering 21. Even in like a big market fall off, it'll be like 30, 35% debt to assets. So just a remarkable turnaround in just 1 year. And that's because they were smart, right? They didn't pay any dividends. They didn't do anything crazy. They took all the cash, they paid down their debt, and they've put time charters on. So really big award, I think, goes to TK Tankers for just a remarkable turnaround. I do not have a long position, look, because it's not the cheapest stock. So sometimes I pay extra for like a premium stock, but look, if I'm going to pay extra in this market for a premium stock, I'm probably going to go to the front line, pick up Frontline with Robert. TK Tankers, not quite cheap enough for me yet, but look, if it drops back another few bucks, time charter book's going to help you out. All right, hopping in the chat here, see if there's anything else. I got about 2 minutes left. The threading on Rocket Chat, I know you guys don't like it. It's kind of annoying to me too. I can't always tell exactly what's in here. Yeah, it looks like that's pretty much it. Just end all commentary for the week. Look, there's an article in TradeWinds that came out today. It's kind of like slamming retail. It says like dumb money and stuff. Look, I sat down with a really good guy, Joe Brady over at TradeWinds. We talked for like 15 minutes. He said, man, what the hell is going on in the market? Look, all these companies putting out amazing results. I've talked to 4 analysts this week. They're all like bashing their heads against the wall. They can't figure out what's going on. Look, I'll tell you what's going on. There's a YouTube video. It's got 175,000 views by some guy named Jeremy. Nice guy, I'm sure, right? But his tanker, analysis and understanding of the sector was just abysmal. He's recommending Nordic American Tankers, which is like the worst stock in the entire market. You got Jim Cramer hawking Nordic American Tankers, and then we had this entertaining article. It was well written. It was fun to read, but it was on Wall Street Bets on Monday, saying like, go all in. Scorpio Tankers, they can't miss. They're going to slam earnings, and or Euronav all in. And look, there was almost 100,000 folks coming into the sector, and 100,000, I mean, it's unbelievable. But you got all these folks coming in for a trade, and they're all trying to trade like on earnings. Look, what do you think happens when everybody is trying to trade on earnings? This is not going to turn out well. So that's basically what the article is talking about. I said, hey, look, smart buyers, or excuse me, smart money was selling calls, selling puts. That's what we've been talking about in the chat. It's okay to gamble. Look, I had some Scorpio 25s myself. We're going to lose money on those. But, smart money is selling calls, selling puts, and smart money is looking at like a longer term on this thing. So that kind of summarizes that. With that said, guys, happy Friday. Have a great weekend, and I'll see y'all next week on Monday.